Welcome to this edition of Mango Spaces on the 10th of June. June is always an interesting month for us here in Kenya. It's a month that usually tends to refocus attention and to sharpen minds as we ask, what exactly is our government, our employees spending money on over the next 12 months, and how exactly are they going to pay for it? So this week, hundreds of persons in your employ in Parliament will be debating not just the spending plans that cover the next 12 months from July 2025 to June 2026, but also they'll be trying to figure out exactly what kind of policy changes will be needed to cover the cost of that expenditure. So here's some of the headline numbers that we need to keep in mind when we're having this discussion. The Kenyan government wants to spend roughly 1.8 trillion shillings just in recurrent expenditure. So that's things like paying salaries, making sure that offices are staffed, overheads and maintenance. Is the water paid for? Is the electricity paid for? And so on and so forth. 722 billion shillings on capital expenditure. And that covers a broad range of things. That's everything from building new schools, new hospitals, new roads, and so on and so forth. So those two combined, that's at least 2.5 trillion Kenyan shillings. In addition to that, remember, you've got at least 1 trillion shillings of planned expenditure just on servicing foreign and domestic interests, and another 800 or so billion shillings just on servicing both foreign and domestic debt redemptions. Now, one of the key assumptions baked into this budget is that the finance ministry will somehow be able to raise, just in taxes alone, 2.8 trillion Kenyan shillings. I'll repeat that number for you because we'll come back to the question of taxes in a bit. 2.89 trillion shillings just in taxes. But remember, past tax targets have been inflated, and often than not, they've been missed by enormous margins. And that suggests that we're in for another year of elevated deficits. So where exactly does Kenya then go from here, and how does that affect you as an individual and as a business person or as an employee for that matter? For that, we've got fantastic people on the panel for you tonight. We've got Anne Mangondu, who's the Senior Tax Manager at Deloitte. We also have Raphael Agung, who's a Group Director of Global Markets at NCBA Bank, and there's Churchill Ogutu, who's an economist at IC Group. And over the next 60 minutes, we hope we'll give you a useful primer of what you can expect, not just on the taxes side of the 2025-2026 budget, but also on the spending side as well. To begin with, however, I want to get in 60 seconds or less from all my panelists your initial thoughts on what's the key thing that's standing out for you in the 2025-2026 budget. And let's start with you.
Thank you, Rama, and good evening, all of you. I know much has been said out there in terms of this year's budget, and there's the word going around that there are no tax-raising measures. But as we continue with the discussion, you'll actually note that the 2.8 trillion you just said, of course, there are some hidden kind of revenue-raising measures from tax perspective. Of course, again, the key concern, as you said, and put it well, is about debt servicing, remains thorn in the flesh, and also seeing how we bridge the gap in terms of the budget deficit. So as we continue to see how this plays out, back to you, Rama.
Indeed. And in addition to what Anne is talking about, one of the things that we often tend to gloss about, but if you listen to the central bank governor a little earlier today, that question of pending bills, right? The amount of supplier credit that the Kenyan government owes to many companies and individuals in this country. That stood as around 461 billion Kenyan shillings by the end of March. And usually you don't count that or think of that as part of public debt, but it is money that is due to others in the economy. Raphael, I want to bring you in. What stood out for you in this spending plan from July?
Thanks for having me. I think what's standing out for me in this is the context in which the budget will be read or these numbers are being shared. So if you think about it, same time last year, the context was a very triumphant cabinet secretary or treasury, if you will. They'd just taken out the defaultation, refinanced the Eurobond. On the macro side, on the present side, I think everything was beginning to stabilize. And so you saw a very triumphant, very confident cabinet secretary putting through numbers that actually look pretty ambitious and bold. We all know what happened on the back of that. Come this year around, the contrast is pretty clear. You have subdued growth prospects. You have a much, much tighter fiscal space. And as you point out, revenue expectations that are completely a mismatch from what one would probably expect to realize. And so it's just markedly different from 1 year out.
Indeed. And we'll certainly get into that context in a bit more detail as you continue. Churchill, you're on the debt and the bond financing side of things. From your point of view, what stands out for you in this relatively ambitious budget plan?
Thanks, Rama and Wango, for having me. So from the debt financing perspective, We are still at a point whereby domestic borrowing will still be doing much of the heavy lifting in terms of a higher proportion of financing from domestic financing, as has been the case from Supplementary 1 and Supplementary 2. And from the external side, obviously, we are not seeing some of the multilateral financing that was the front end of the current financial year. IMF financing, probably we could get World Bank financing in the next financial year. So that was standing out for me in the financing of the budget for FY25-26.
Let's start with the Budget and Appropriations Committee report, because over the last 12 months, actually more than that, if you want to extend the timeline all the way through to before the pandemic, one of the things that we often hear, and a lot of our audiences will have heard, government officials will often talk about fiscal consolidation, the need for fiscal consolidation. And in a very simple way, whenever you hear a public official talking about fiscal consolidation, what they essentially are talking about is reducing the size of the fiscal deficit, i.e. the amount of money that they have to borrow in order to fund public expenditure. But the reality is that we've missed a lot of our deficit targets over the years. Churchill, from where you stand, the Budget and Appropriations Committee essentially is proposing to raise rather than lower total expenditure, which is ideally what we'd expect to see. Assuming the spending plan goes ahead, where does that leave our fiscal deficit position?
So just to start on the spending plan, where the Budget and Appropriation Committee is coming to intervene is the spending plan to what we call the ministries, department, and agencies, or the spending by the national government. But then we have rigidities on the overall budget. We have issues such as consolidated fund services on one hand, which they cannot tweak whatsoever. And also the equitable revenue to counties, whereby initially it was proposed at 405 billion by the National Assembly, and Senate came with a higher figure, so they'll go into mediation. But nonetheless, these are rigidities in the budget. So where the Budget and Appropriation Committee is coming to intervene is actually the spending plan to the national government. So we had the estimates that were tabled by National Treasury at the end of April. And also on the judiciary side, we also had some estimates by the Judiciary Service Commission and also by the Parliamentary Service Commission on the legislative side. So that is what was tabled at the end of April. So Budget and Appropriation Committee now took it over, and they had interactions with departmental committees. So all of a sudden, some funded and requests came through from the departmental committee, because they're the guys who interrogate the budget numbers. What I can tell you is that there's some money, as of last week from the report, they allowed an increase of 2 billion. By it, there was 254 billion that remained outstanding or unfunded. And then as of yesterday, when after the report was tabled and then there was a debate, pretty much the latter part of last week, committee of supply, so they were approving the votes. And even then, we saw some increase to the tune of close to 11 billion. The budget has increased by 44 billion from the estimates that were tabled in April. It's obvious what the Budget Appropriation Committee, or where we are right now. But that tells you how these pressures around fiscal consolidation is. We still have unfunded requests, and from this unfunded request, 2 months, 3 months, they prioritize and bring about what we call Article 23 of the Constitution, and that brings back to supplementary budget down the line. So that is something that we need to be alive of, and that even subsequent tweaks to this budget that we are expecting, there's a higher likelihood that it will have some upward bias just based on that. In terms of the fiscal deficit, as when it was tabled in April, we are talking about 4.5%. This is around 884 billion thereabouts, but some back of the envelope math based on the numbers that came from this particular committee. So my number is around 916.6 billion, so 4.8%. So that there's already an upward bias, and yet the budget statement hasn't come out. So that's pretty much what is at play right now.
And I know we spoke about tax issues a little earlier in the introduction, and the main message that the finance ministry has come out with ahead of this budget is that, look, we're not raising the taxes. Right? We're not increasing VAT. We're not increasing excise. We're not introducing new tax bands for income tax. That's been the main message that they're coming out here with. But are there changes that they're proposing to the tax code where the end result would essentially be raising the prices of goods and services that individuals on the space today pay for as part of their daily routine?
Actually, Rama, you're spot on, because look at this bill that was released. It's a mixed bag of a number of issues. Actually, I can put them in 4 buckets. You find their proposals, of course, aimed at reducing the tax expenditure, We also have proposals aiming to expand the tax net as well as those that are revenue-raising measures.
Just before you go on, tax expenditure is a term you and I would use more often than not, but
Okay.
for some of our audience, it might not be familiar. Please give them a layman's definition of what we mean when we say tax expenditures.
This where now the government loses tax revenue because of giving incentives to some sectors or individuals. So we found there are proposals that have been proposed to repeal such incentives for some of the sectors. And you'll find more these in the indirect tax space, where we have items being moved from what you call exemption to standard rated. Exempt supplies is where when you're supplying the item, you do not charge VAT. But with the proposals in the bill, you find that the items now will be subject to 16% tax rate. For instance, we have items like the issues of aircraft, the parts that are used by aircraft, those are previously exempt. Now they'll be charged tax at 16%. Of course, that will lead to increase in the tax revenue. We also have issues of passenger vehicles, the locally manufactured and assembled motor vehicles. Previously, this has been exempt from VAT. We see a move now to have these standard rated at 16%. We also have items moving from what we call zero rate to exempt. These are items where no VAT is charged. Rather, the supplier goes to get refunds from the government. So for this now, moving to exempt means these persons will not be able to claim the VAT from the government, and they'll likely pass on this to the end consumer. We have items specifically for construction of hospitals. We also have materials for construction of affordable houses, as well as tourist facilities, which now will no longer be zero rated but exempt. We also have investors in the exploration industry. These are people who are involved in geothermal, oil or mining exploration and ventures in the country. For the longest, they have been enjoying zero rate on the goods that they receive. So going forward, this will no longer be available for them. Then we also have a key one in terms of the animal feed, that input that are used to manufacture the animal feeds now will no longer be zero rated, but will be moving to the exempt bracket. Also, we have issues of mobile phones that are either locally manufactured or assembled. This had been previously zero rated, meaning there was not VAT on it. Moving forward, there is a proposal to have this exempt. Also, issues of to do with electric bicycles and buses. So you find for such, then those incentives will not be available. Therefore, the government will reduce the tax expenditure, but again, at the same time, also collect some money from the suppliers or the final consumers. Again, you find moves towards reducing the tax expenditure through limiting of the period to carry forward losses. What you have currently, you can carry forward your losses, definitely, but with the proposal now, you only have 5 years, meaning those entities that have huge tax losses, we expect them in a few years, they may start paying taxes. We've also had what we call preferential tax rate, especially for entities that were constructing housing units, residential housing units, and also assemblers of motor vehicles. They had a preferential tax rate of 15%. We see this is being moved to 30%, meaning now there will be collection of another 15% from these entities. The other areas of tax raising measures, which is not so direct, is more through the excise duty. We all know the issue around taxation of the digital economy. We did have taxes introduced through the corporate income tax space and also through the value-added tax. So what the bill has right now is to extend requirement for payment of excise duty on supplies made through the digital market space. So again, that is a move towards revenue-raising measures. So in as much as the word out there are no revenue-raising measures, the approach by the government to reduce the tax expenditure and also introducing excise duty on the digital economy will bring in a few more revenue for the government.
All else, of course, being equal. And it is, considering all the complaints that I've heard from firms in the animal feed space who say one of the issues that we have in this country is that just the cost of producing feed is enormously expensive. The fact that we're now effectively tinkering around the tax code on that and not in a way that essentially delivers dramatic savings, deeply concerning, considering how big agriculture is in this part of the world. Raphael, I want to come back to you and the point you raised a little earlier around the question of context, because looking at a 5-year window, the fiscal strategy that the Kenyan government has had over the last 5 years, maybe the exception of 2020, has been let's raise this marginal rate of tax. Let's introduce a new band of taxes. Let's increase excise duty, for example, on mobile money from X to Y in order to increase tax revenue. But in a lot of those years, if not all of them, I believe, tax revenue targets have simply not been met. The target for this year was to raise around 2.9 trillion shillings in tax revenue. Government eventually had to chop that down and bring it down to around 2.3, 2.4 trillion. And even that is going to be a bit of a stretch. And at the same time, and our audience will know this because every time they go to the supermarket for daily shopping, for example, a basket of goods that would cost them 10,000 shillings now costs 20 or 15 or 17,000 shillings, right? Your cash really doesn't stretch as much. We're looking at 5 consecutive years of declines in real wages. What combination of tax cuts should we be thinking about in order to jumpstart domestic growth?
I think the first point to note is in the years that you outlined, so last 5 years, it's obvious that the government has been missing its revenue forecast, almost 12% on average. And of course, that creates this sort of budgeting discipline, if you will, that I think Churchill was speaking to earlier. So the first thing is just to note that the issue about accurate forecasting has been hitting government the wrong way, but also to appreciate that the context that you refer to is coming on the back of structural weaknesses that are beginning to bear. You have to go back almost 2 decades and appreciate that the country has run public finance heavy capital investment type of development strategy, some of which is causing the difficulty around the tax-based question. And I think this is the crux of the matter, which is that you're not being able to meaningfully expand the tax base, yet you have expenditure priorities that continue to rise. So for instance, if you listen to what Churchill was outlining earlier, on the MDA side, or demand from the counties is just in terms of development priorities and or recurrent expenditure. If you look at consolidated fund services, every pressure, there is no room at all to reduce expenditure. As a matter of fact, rises, as you did point out. So the challenge is the growth model has ended up giving you a very small cow, which cow cannot yield enough milk for you to be able to respond to all our priorities of the day. There is no room at all to even imagine tax cuts because, first of all, your revenue is falling short. Your development expenditures are not of where you need them to be and running at variance where we want to see running a deficit cumulatively, and you're struggling to close the gap. So what has to be done, and which is what I think is the beauty of the attempt they've done this time, which is to look at the tax expenditure, which I think my Emma has already explained very well, is to try and see how you can take out some of these slippages and be able to close the deficit. Because as you pointed out, we need to consolidate our fiscal balances and we need to do so urgently. Otherwise, we will not see the requisite growth. But more importantly, Ramar, I think people forget that ultimately it's a growth question. If you're not growing fast enough, the revenues won't come through. If you look at the KNBS numbers, 2024, particularly now we went down 4.5 at the output level. That sort of growth outcome gives you specific revenue sort of performance. And so macro fiscal performance is slowing down on account of a slow growth. You do not have wiggle room or fiscal space to be able to resuscitate the economy. And so it's a bit of a tight spot, which is why I think if you look at the budget policy statement that they put out since February, it's trying to work on the margin to see whether you can actually stabilize things. This is the challenge, and I don't think at your specific question, there is no room to cut taxes. In fact, a matter of that, the struggle is if it weren't for the social sort of opposition to the tax burdens of the day, they would actually be raising taxes if they had the room.
The counter, though, would be individuals would look at the way the Kenyan government works and say, hang on a minute, we can tinker with tax expenditure concerns on the margins, as it were. And in some instances, we'll hear proposals where we say, if tax exemptions are the problem, then let's get rid of them entirely, have a much smaller, more consolidated VAT Act and Excise Duty Act with a very narrow set of exemptions, lower the rate, and hopefully that triggers an uplift in terms of revenue collected at a much lower rate. For example, drop VAT from 16% to 12% to 14%, with a very narrow set of exemptions. But the other counter argument to that would be, if you look at the way government spends money, right, there's an enormous amount of waste all over the place. So for example, if we look at the spending plans for 2024, 2025, you have a lot of duplication, for example, where you have the office of the deputy president having an allocation to deal with alcohol abuse, and yet we're also allocating money to something like the CADA to deal with the exact same problem. They also question about allocations. For example, if education, for example, is the largest single line item on the government side as far as spending is concerned, especially on the recurrent side, and we know there are instances where kids are learning under trees. In that sort of context, it therefore makes no sense to be allocating the better part of £1 billion shillings to the offices of spouses of the president and the deputy president. So in that sort of context, and I'm sure we can find tons and tons of ways to go line by line across MDAs, there is room essentially to slim down this leviathan that is just sucking more cash out of taxpayers' pockets, isn't there?
Yes, from I can say you raise efficiency questions, and I'll give you a simple analogy. There's a reason why Donald Trump appointed the world's richest man to run the Department of Government Efficiency. If you look clearly at government expenditure, there will always be room and a lot can be done there. So there's no question about that. And I think we can take a similar approach here and see what sort of efficiency gains we can make. However, I think the point that's often forgotten is we are at nascent stage of development progress. I think we had significant shocks. So for instance, if you take 2024 and the outcomes that we've seen, a charitable view to the government position and counter to your view would be, okay, so we didn't meet our revenue expectations. Why? Because 1 or 2 months we were out because we had the shock around the Gen Z protests. Fair point. I don't think anybody quibbled with that. But that's also just how we run public affairs. The upshot of it is we made some choices about 2 decades ago. Those choices, and I think David Lee has been very eloquent around it, those choices have given us a particular structure of our economy today. That structure is struggling to be able to yield enough milk. If I was to, and the easier place to go, of course, transparency around the expenditure reforms that can be pursued of the type that you mentioned, those are valid. But before I get to that, there's just a question about tax productivity. And there's that issue that are we aware we need to be with regard to tax productivity and the issue that we'll raise in terms of the tax expenditure framework as well. I think there's work there on the revenue side that we could work on. Of course, I take your view that it is correct. We really could do a lot with better discipline on the expenditure side. But as we all know, that's subject to the political process. We know the difficulty around our political class. Yes, we have greater vigilance. Some of these spaces that now you are inviting us to is increasing transparency. And I believe we will see slower, easier reforms in that end. But I was concentrating more on the revenue side. And I think in that sense, if we can be more, at least we can be sure about our revenue output, then I think we can plan better in terms of holding the political class to account on the right-hand side to make sure that there's no wastage of the type that you pointed. But yes, I agree. Consolidation has to look at both sides. And the expenditure side is one place where perhaps we could also use with some better scrutiny.
And just one last follow-up to you before I go to Churchill on the debt service question, because I'm sure the question that a lot of the people on this space are going to ask is, hang on a minute, if this was a personal event, right? Someone has come to me, a family member, a friend, whatever, they've borrowed money, and I can see they've spent it badly. Why should I give them more cash? Because for a lot of Kenyans, when they hear the question of we need more revenue because we've got these rigidities in the budget, they're going to be like, no, hang on a minute. I have nothing left to give. Dealt in 5 straight years of diminished real wages. I have nothing more to give. I need a break. And that growth that we're talking about, can it really come through if we continue with that trend of diminishing real wages and limited formal sector job creation? Because going back to 2020, 2019 even, this formal economy used to create at least 100,000 jobs. Last year, the figure was 45,100. So clearly the current approach, at least as far as tax policy is concerned, is not delivering the results we would like. It's destroying the growth space rather than helping it grow.
I think fair point. The question is, previous generations have taken decisions that have consequences, and we are living through that. We elect government for 5 years. We have a new administration. This is the third budget they'll be reading to us. And the question is, they inherit some of these successes and some of the faults or cracks. The only way you can run government is you have to tax and spend. You can say, look, do we need to have our hospitals running? And the answer is yes. Do we need to have our roads operational? I think the answer is yes. So there is non-discretionary expenditure that we can't run away from, for which we have to pay taxes. Unfortunately, the decisions of the past are it. That's why if you look at the Constitution, for instance, it speaks about intergenerational equity. So this is a point that they sought to address, which is what sort of decisions can we take and with what impact to the future generation. We will get there. I think right now where Kenya Kwanza finds itself is they needed to address the debt sustainability question. We have significant consolidated fund service priority eating into what they could use, make our lives better. And that's just a consequence of some of the decisions they made in that fiscal space. They really do have to come back and raise money to be able to get government running. Otherwise, government would stall.
I want to move on to the debt question because you've given me a fantastic segue into that with respect to Churchill. Because when you speak about consolidated fund services, the way the Kenyan public finance system works is money comes in, the first thing that we settle, debts, right? It's the equivalent of your salary checks into the bank at the end of the month. The first thing you sort out is pay whoever you owe money, the bank, the SACCO, the shopkeeper down the road, all of that. Now, what does our debt position look like, especially for next year? So the plan is to spend at least 1.1 trillion shillings on interest and another 800 or so billion shillings just on debt redemption. That's both domestic and foreign. So in total, we're looking at a spending outlay of about 1.9 trillion Kenyan shillings. Churchill, one of the things we've seen this year and last year, in last Feb, we had a buyback program for the 2024. We had another buyback program earlier this year as well, I think around in February. What options do we have to push out maturities into the mid-2030s and to lower the cost of debt service? Any appetite, as you see it, for more bond buybacks at this stage?
As you have put it, we've seen liability management operations both last year and this year. Also for this year, we've seen liability management operation, basically the bond buyback, also on the domestic side, which had been initially preempted by the National Treasury. The idea was to do a switch auction. So basically these maturities that are quite heavy this financial year for the months of April and May, so to switch them, but now they shelved it off and then eventually did the buyback. So that has been pretty much the playbook that we are seeing from the authorities. And increasingly, just to reduce some of these debt vulnerabilities. As you've correctly pointed out, if you look at even the stock of interest payments, which was 1 trillion Kenya shillings in the current financial year, and then there's a jump of close to 100 billion to that to 1.1 trillion in the next financial year. So that just shows what Raphael alluded to, some of these the past mistakes catching up with us in terms of the interest payments. But as I proceed to your question, if I may look at even the disaggregated data, you find that the largest component of even on the interest payment is domestic debt, because we're getting our debt in commercial terms locally. Externally, it's a mix, some on concessional terms, semi-concessional terms, and commercial terms. But if you look at the biggest contributor to this uptick in interest payments is that domestic debt has been quite expensive. But nonetheless, if you look at even what happened yesterday with the reduction in the key policy rate by the Central Bank of Kenya, indeed, they have reduced the policy rate by 3.25% from August last year. So that has been a signaling. And you've seen even interest rates at the short end, this is treasury bills, even coming lower to less than 10% as of last week's auction. And even on the treasury bonds rates, we haven't seen new issues. But we have seen that even the rates on the treasury bonds side starting to come lower compared to 12 or 18 months ago. So you can see that in the long run, if this continues this way, it will reduce even the pressure on the domestic debt. So from that perspective, in terms of the domestic debt, from a long-term view, in the play of events that has happened in the last 7 months, at least you can see that we'll be in a much more comfortable levels going forward, because of the interest component probably may stabilize at this level, if not increasing from where we are. When you look at now on the external side, the play has been on the commercial debt rather, and this is on the Eurobonds. And also this year we saw some of the liability management because they picked $1.5 billion. 597 was towards the retiring this Eurobond that is maturing fully in 2027. And the difference is now some of these upcoming syndicated loans in the months of September and of October. So that has reduced the short-term vulnerabilities, but this is commercial debt. Looking 1 year ahead, we are not seeing that kind of outsized maturities from commercial debt. We have 1 or 2 maturities, but it's not as elevated as the levels that we were in a year ago or even into this year. So it just gives you some room of comfort from the authorities. If they go ahead and do a liability management, as it is now becoming a norm that the months of February and March is the months to look out for. It will be a plus, and probably they'll be targeting the upcoming maturities. This is the 2028, which is $1 billion. So that's the next bullet maturity. That is likely to be at play. As to some of the other stock of the external debt, I've talked about commercial debt. And if you look at multilateral debt, I don't think there's any headroom on that in terms of restructuring one form or another. This is IMF debt, this is World Bank debt, and this tends to be somewhat ring-fenced even in other jurisdictions. So we may not even see any kind of a reprieve in terms of restructuring that debt. And collectively, we're looking at 55% of external debt is owed to the multilateral lenders. And from this year, we are starting to repay some of the debt that we picked from the IMF in 2020 onward. So we'll start making some payments even the next financial year. But now the other component of the external debt, this is talking about bilateral debt stock. So that's right, about 20% of our external debt stock is owed to bilateral lenders. The biggest of that is China. So there's been some conversations around restructuring Chinese debt. I think that is, if you sieve away bilateral debt, you have Chinese debt accounting to 2/3 of that bilateral debt. So that is the significant debt. So we've had conversations, or there was a trip to China, and out of the trip notes by the authorities, it was alluded to that one of the discussion points was around proactive restructuring of that particular debt stock. So if it materialized, that's well and good. But you've seen scenarios elsewhere on the continent, some pushbacks by Chinese as a creditor on some of these names, Zambia, Angola. There's been a bit of some hurdles in terms of alleviating the debt stress that these countries has had owning the Chinese debt. So it might be a long haul for Kenya to be able to have that materialize. But if you look at the other non-Chinese bilateral debt, I mean, it's small amounts which may not meaningfully move the needle. So I think even going on, bond buyback or restructuring liability management operations on the commercial debt is more viable, opposed to the other external debt stock, be it multilateral of the both of that intent, and now bilateral on maybe a bit versus China.
And we're going to bring in Rafael on this in just a moment. And I see Stephanie Kimani, an economist who's been on these spaces before, especially last year. And I remember one of the arguments she made last year was with respect to domestic financing. If you're in government shoes, stop accepting expensive money, which, going by the sort of trends that we're seeing now in the T-bill market, at least, it does seem that we're seeing those rates come down. Rafael, I know you want to weigh in on this question around how we manage our debts, both internally and externally.
I think Churchill has been very eloquent in just showcasing the market improvement we see from, say, 12, 15 months back, which is that government liquidity has gotten better. We did get a rating upgrade early this year precisely because of that. But more importantly, a maturity profile that is outlined is, I guess you would have to give credit to the liability management operations, both external and domestic, that he has pointed to. So the actual path is that the outstanding public debt stock is still an issue. And I think the subtext of what Churchill was saying, which I needed to emphasize, is if you look at the DSA, which is the debt sustainability analysis done by both the IMF and the World Bank jointly, we still are struggling on the external side. And so high risk of debt distress. Yes, he beat back that maturity profile, gives us breathing room. Hopefully, we are able to address the public finance questions that you raised at the beginning of the call, which is how do we address the deficit and how do we consolidate? What is forgotten in most of this conversation is eventually we won't achieve anything without growth. And my concern is that growth is stalled for reasons that we can delve into, but I think is pretty obvious to everybody. Output potential for Kenya is arguably north of 5.5–6%. We have the 2024 number at 4.5%. You've just seen recent forecasts from every house that's pontificated on this issue, suggesting 4.5%. The latest being, of course, the World Bank today at 4.5% for 2025. The BPS assumptions is still pretty optimistic, suggesting that we could pull off growth at 5.3%. It's anybody's guess whether that's tenable given this time of the year. So it tells me that the growth question has to be prioritized really urgently. And so if you look at the two limbs of policy, I think we just heard from the central bank governor this morning or yesterday. The decision directionally, I think, was opportune. It's running towards the right direction, addressing the growth question. But I do think that there's still wiggle room to go much lower, especially if you take the view that on the fiscal side, and I think both you and previous speakers have been very eloquent about this, there doesn't seem to me any wiggle room meaningfully to provide fiscal stimulus of any shape or form. So we do have to address the output gap urgently, and that's the growth question. And it seems to me like monetary policy remains to be the only game in town so far. In fairness, I think if you look at the conduct of the MPC or the central bank, if you will, you'd argue that they've delivered remarkably on the stability question. So whether you look at all the three key prices, those have trended, be it currency, interest rates, as Churchill pointed out, coming down very steadily and very stable, and inflation very low and actually within target. So I do think that if you address the debt sustainability question squarely, we have to go back very quickly to growth, and we have to resuscitate growth urgently, especially in the absence of any meaningful fiscal stimulus. And I would argue that the kind of whether administrative or just sheer countercyclical policy moves that are being pushed urgent, and I think monetary policy still has some way to go. That's what I could add, Rama.
And I'll get back to that growth question because it loops back into the debate we were having a little earlier. How do we resuscitate it? And to be clear to all my audience here, my personal bias is that I would love to see tax cuts. But of course, there's always room for debate around these things. And I want to bring you back into the conversation on this question of pending bills, because it's been a long-running concern over the last decade. Every time myself, other individuals are sitting on company results, especially on the banking side, and now we see NPLs trending higher and higher. Central bank put out an interesting figure yesterday, 17.6%, roughly you could say 20% of the entire loan book is having problems. And a lot of that has been provisioned for. But we're seeing some interesting ideas coming through on how to deal with that backlog problem. There's some individuals in government exploring the idea of securitizing revenue streams like the road maintenance levy fund, for example, that we pay every time we buy a litre of petrol, a litre of diesel, in order to offset some of those long overdue payments. Does that idea have potential to work? And are there other interesting solutions that we can think about within the tax code to essentially raise the money that we need in order to settle these bills? So say, hypothetically, for example, if you have all these bills that have gone through the review committee that the finance committee set up, can it then say, look, okay, you owe us $1 billion, Bob. We can offset that against future tax obligations, stuff like that. Is that a realistic option?
I think it would be a tall order to imagine that you can use tax revenue to offset the pending bills, noting what my colleagues have talked about in terms of the pressing and the competing needs that the government has to deal with. So it might not be easy to have that being discussed anywhere. But having said that, we can see that there are ways the government is usually trying to expand the tax net, maybe just to try again to assist in paying these bills. There's an attempt to actually leverage so much on the digitalization. The issue of e-teams. We've also heard of this issue of sharing of information with the Commissioner of Taxes. I know there's a big debate around the issue of personal data as well as trade secrets, because there's a lot of pressure, as we all agree, to collect revenues. So if the government is able to widen the tax base, bring all people with the tax net, maybe that would be a way to then allocate more funds towards settling these pending bills. But I think more about now, again, expenditure rationalization, which we have all seen that it's very key at this point in time, because as we say, we stretched in terms of the government cannot introduce other taxes on especially the employees. So they just have to work with what is available.
Rafael,
I think you are spot on. The pending bills question is the key problem in terms of just banking sector outlook. So as you point out, in actual fact, NPLs north of 17.6, and what we understand from the central bank data is that this revolves around the pending bills question, actually contractors that are having been paid. A little bit of context is important here, which is there's a question about legitimacy of some of these claims and what have you. So you may be aware, I'm sure you do, Rama, that the president tried to come up with some sort of commission to look at them, and that ran into trouble with the courts.
Raphael, it seems you're having problems with your connection at the moment. Churchill,
The issue around pending bills has been here for a while now, but at least we have the verification committee on pending bills. I think from what I gather is it's at the tail end of its works. And we've seen some efforts around clearing some of the pending bills, more so the road sector, which has been prioritized, at least in the current financial year. I think the number is around 80 billion that has been already somewhat being securitized. So that is the route that the authorities are looking at. So basically the road maintenance levy, initially it was 18 shillings per litre. It was increased to 25 shillings. So that was 7 shillings increment. But then again, if you look at even the way it was increased, there was some pushback. It was around the time of the Gen Z protests. So at that point, it was a bit hot potato issue of even pushing through this particular proposal. But then again, it had its way. So here we are. But the proposal I've seen is that this particular the securitization, rather than the 7 shillings that was there in July, so they want to increase it to 12 shillings per litre. So the road maintenance levy, close to half of it will be ring-fenced. So that is the strategy. The idea is to raise 175 billion to clear the current pending bills to the road sector, and then 125 billion to the new road projects that are coming through. But if you look at the stock, or ideally the road maintenance levy, the amount that we typically get in any given year, so that's right about 90 billion. So it's giving you like the securitization will go at least 4 or 5 years of clearing the road sector pending bills, and also some of these road projects that are still in the pipeline. But having said that, and looking at the next financial year, it was emphasized by National Treasury that they would want to prioritize 149 billion. So where this 149 billion is coming from, the verification committee, the authorities had earmarked to settle 229 billion, of which 80 billion has already been sorted out to the road sector. So the balance of 149 billion, that's where they would want now to have some privatization. So the proceeds from privatization to the tune of 149 billion, that is what will now be used to settle this 149 billion. It's all good on paper, because the question now that arises is, what is this pipeline of projects that could be privatized? And if there's any privatization, will it be direct asset sales, or will it be via IPO, initial public offers, through the Nairobi Securities Exchange, or even those secondary IPOs? We still have some question marks around that, but probably you could be able to get some visibility even from the CEO speech tomorrow. But having said that, we've also had some initiatives speaking about privatization, this committee of experts reports, even the documents within the PPP units. So one of the things also around it is that they are proposing to create some fund. One of the things that stood out for me, salient from this report, is a multitude of funds that is being proposed. So one of the funds that the committee of experts that were looking at the PPPs, public-private partnerships, is this particular fund called National Pending Bills Liquidation Trust Fund. It had some draft regulations around that, but the idea is primarily to settle some of the pending bills that is owed to the pension sector. If you can disaggregate the pending bills, as of March, it was around 421 billion. Significant chunk of that is now the unremitted pensions that typically goes towards the pension sector. So that is the idea behind this, but we have not seen the regulations formally tabled. We haven't seen even some of the key recommendations from that report being formalized. But I think that is one of the proposals that is coming out, that amongst other proposals, securitization we've seen, and also this kind of around settling the domestic areas.
Just a very quick question to Anne before I come back to you, Raphael. If this pending bills verification committee has been set up, let's assume for the sake of argument, they come in and they say, yes, we agree, the paperwork tracks, the work was done, we owe company XYZ 500 million shillings. Is there anything in Kenyan law that says that this company cannot turn around and tell the government, look, I know you guys don't have the money, but you have an obligation to me. I know I'm going to have future tax obligations to you in terms of corporate income tax, excise duty, whatever the case might be. Why don't we just net these off? Is there anything in law that stops that from happening?
We don't have such a provision within the current income tax law of the land. So basically, you can only offset future tax liabilities against a tax that you've already paid. This would take maybe a discussion by the National Assembly in terms of maybe bringing something of that sort to within the tax laws, but as is, that might not happen.
Raphael, please come in on that very specific question that we're talking about with respect to novel ideas of dealing with our pending bills.
Thank you. I apologize for my connection. I caught Churchill enumerating some of the numbers behind the securitization strategy. I think it's important to point out that, one, in the absence of fiscal space, these sort of solutions is what would come to bear. So to the extent that we are having novel discussions around securitizations as a first step, I think that's a good idea. But I think it's important to remember the context always, which is that the legitimacy of some of those claims is in contention. So it leaves us back to the SOE reforms. And I think Churchill also did point out to this, that we have to cut it both directions. Either we get out of the state-owned enterprises that are not helping us with anything, raise some revenue that way, pay up the spending bill questions. It will invariably reduce the NPL question that you pointed to. And I think we understand from the central bank so far that a big part of that NPL burden is actually just around contractors. And that if that could be addressed, perhaps we'd see some gains around extension of credit to the private sector. Keep in mind that all these things speak to the governance concerns that I think has been the subtext of your counter-argument, Ram, and I think it's a very good point. We have raftful people claiming money in excess of 600 billion, sometimes the year figures as high as 700 billion. By the government's own admission, they don't trust every of those claims, as you'd expect. And so you have to try and get a transparent process of actually resolving the same. Yet that number is so significant if you look at it in proportion to GDP that it will actually help kickstart a lot of things. There is a sort of ricochet effect in terms of if you resolve for contractors, the supply chains around it, benefit, you get a lift off, it could actually be very stimulating. So I could not but emphasize that, yes, securitization as a solution, which is being explored currently, is one thing that I think has come in rather late, but better late than never. I think we should proceed apace.
And I want to come back to something that you mentioned with respect to the question of this drive by KRA to access a lot more private data that is held by companies, by banks, and so on and so forth. And for context for our listeners, essentially the Treasury is trying to change Section 59A, 1B of the Tax Procedures Act, which effectively bars KRA from compelling businesses to share personal data. So, for example, KRA just figuring out how much cash do you actually have? What are the sort of transactions that are going in and out of PESA account or your bank account and so on and so forth. Walk us through the context of this fight between the argument that the Kenyan government is saying, look, we want better access to data so we can essentially increase the amount of revenue that we can collect out of businesses and individuals. How would this affect your clients? And
You're right, Rama. It's a huge debate around access of information for customers and taxpayers. Of course, the commissioner has the powers to request for information from any person for a third party. What you note through the Finance Act in 2023, the law was changed to enable the commissioner to integrate data systems with some of the key taxpayers. So at that point is where then it was well articulated that the commissioner cannot go ahead to request for private data, personal data, as well as trade secrets. But this is, as you put it, under the current bill. They want to take away that limitation. They want now the commissioner to have access almost to every data, which we find is not going very well, especially for institutions like banks and the like, where it is require a lot of confidentiality in terms of data that is given by your client. Again, also to some extent, this goes against the regulations around the Data Protection Acts, which if a bank requests for my information, it's just for the purpose of my banking transactions, then there's no way it should be taken away to another person, use it for a different purpose. So we don't know where they are coming from in terms of trying to bring in this aspect of the commissioner being able to now command or request for these personal private data from third parties. So it's a big discussion, of course, not settled well with people. We just hope that before the bill is signed to an act of parliament, then this would be reversed.
just for clarity, so how does it work right now? I'm trying to essentially create a clear picture forward so we can say the current situation. Say, for example, KRA says, Rama, we think you've not paid all your taxes based on transaction. So they would have to go to court and get a warrant to say, look, we want access to Rama's bank account, his M-Pesa line, and anything else that's associated with his financial record. That at least is my understanding of how it would work now.
Maybe you can just state what I said earlier. The Commission has always had powers to request that you produce documents or records for your business. Purely, they should just be examining the taxpayer of whether they paid taxes or not. But the proposed move by the legislation that is being discussed is that now the Commissioner can go ahead to request for third-party information. Like you're saying, there's a bank which I bank with, it has my information. So they'd go now to my banker to request for my personal or private data, which you're saying this will be against maybe the Data Protection Act. So as is, they do have powers to request for information for the bank. This is the bank. Have you complied with your tax requirements? Then they audit the books of the banks without going to the extra step of requesting for information of the customers to the bank. But under this law, they want now to integrate data systems of key taxpayers. And then from there, they be given access even to personal private data by such a taxpayer. I hope that clarifies.
Yeah, and just one last question to clarify. They wouldn't need a warrant from a court in order to
Mm.
access it. It would be as part of their routine work, for lack of a better word.
Oh, yeah. They'll be given a leeway, a blank check.
Oh, well, there's good reason for a lot of people to be absolutely freaked out by that. Rafael, I know you wanted to come in on this topic.
Well, not entirely. I think it's just to say that I understand the motivation from a tax administration perspective and given the limitations they have with raising revenue. So the motivation is well understood. I'm also sure that we'd agree with the surveillance question. So obviously, I think it eventually ends up in court and the courts will determine what level of surveillance a state can have even around taxation questions.
I don't want to bring you to a close, but I want to focus on one last topic, the credibility of Kenya's finances, because this is a very ambitious spending plan. In total, it's around 4.2 trillion Kenyan shillings. And to go back to the context question a little earlier, Rafael, the fact of the matter is, right, the central bank governor mentioned earlier today, we're going to start negotiating with the IMF for a new program in September. But looking at all the things we've discussed, right, in the last hour, the waste on the public sector, the lack of credibility around revenue and spending targets. Revenue targets always overstated. We often pretty much undershoot those. And even in the last program with the IMF, missed quite a few targets, a $3.6 billion program. And here we have our employees proposing in Parliament that is to spend more money rather than less, which puts us off the fiscal consolidation path. Given that track record, why should the IMF or the World Bank lend Kenya money in the next 12 months? Because from where I stand, we have this habit of saying one thing and then doing the complete opposite.
I think it's fair to say that Kenya does need an IMF backstop of some shape or form, especially if you look at what's happening in the external environment. So far as we can see, the fiscal strategy thus far is to lean on domestic borrowing. We've all gone on here about the risks to that. So some sort of external support is really necessary as a matter of strategy. And the IMF, of course, is one option. It also plays to just external eyes looking in. So in terms of investor confidence, an IMF backstop is always quite useful in that sense. I think the governor is very mindful of that. And which is why I think he's suggesting that in the visit in September, during the Article 4 consultations, they will pursue some sort of detent with the fund. Should the IMF play ball? That's your question. It's difficult to get into the waste question and justify increased borrowing, whether from the IMF or whichever source, without conceding that, yes, the government does have to address the waste question. But I do think that in terms of intention, from all we can see, both in the BPS and statements from both the executive and especially from the National Treasury, there is intention to address some of these legacy questions around just how we deal with our public debt question more broadly. So I can only wish them well. I think the monetary policy side is pretty very well supportive. We all know that we have challenges on the fiscal side. It requires significant political will. We saw they tried to be very radical just about a year back. There was no social appetite for it. It's going to be a difficult climb going forward, but I think we need to encourage that, at least in terms of policy intention. What I am seeing is clear-headed. The consolidation part now points to just 4.7 to 4.3. That's what they have on the official number. I think last year's numbers were pretty out of whack. It's clear to me that they're mindful of the difficulties around just how you consolidate very sharply. especially within the context of slower growth and struggling revenues. I can only wish them well, Rama, but in terms of whether the IMF should entertain a request from them, it's a political question. We can all debate further.
And just before I bring in Dixon Magacha, who's been keeping tabs on fiscal developments and economic developments in this part of the world, Raphael, there's a train of thought that you introduced a little earlier that I know we didn't get into in more detail, but I know you've dedicated a lot of thought to this. From where I sit, I see 5 straight years of diminished real wages. I see a reduction in investment flows. I see companies complaining, right, about their ability to grow, to expand, to hire, especially for your small and medium-sized enterprises and you're trying to scale. Growth in Kenya has stalled. That was your main argument, especially with respect to the private sector. Why, though? What is the main reason why that growth has stalled?
I think a couple of things. So one, the counter-cyclical policy that we ran in order to address the post-COVID recovery, which is we ended up with high inflation. It required us to tighten monetary policy. And that, of course, ended up in higher lending rates. And we ended up, of course, contraction in terms of extension of credit to the private sector. So that's one. 2, the growth that we'd enjoyed thus far and we continue to enjoy was primarily coming from the public sector side. So there was a significant crowding out factor of the private sector, which I think is part of the point you mentioned. So in the absence of robust private sector growth and then credit extension contracting, the business cycle dynamics are played out as it has. So this is what is constraining growth. And then, of course, the bigger legacy question is you have a structural problem with the economy in terms of lack of competitiveness, in terms of the industry side. So if you look at manufacturing, there's a competitiveness question there that continues to beleaguer our growth prospects. So cumulatively across all 3 sectors, pockets of weakness. As a matter of fact, if it weren't for the fact that we've had fairly decent outcomes on the agriculture side, growth would have been lower. So I think it's partially, again, and I hate to say this because this point has been beaten to death, which is that it's a legacy sort of outcome of the development choices we made in the last 2 decades. But I think it has significantly impaired the structure of our economy and made it a little less competitive. And I think we do need to address that more structurally. But in the immediate term, I guess we have to look for every stimulus that we can get on either side of the policy. And that's what's going on. So that's what's constrained growth. And I think we've had, to your point, also just a sort of growth throughout this period. And in instances where we see job growth, it's on the informal side. So again, that's not pretty helpful because it's not taxable. The tax productivity questions keep creeping back. So it's a bit of a catch-22, but we are hopeful that at least given the stability question has been addressed much, much better than we saw in 2024, perhaps there will be some gains from that side. And so monetary policy, for instance, is thumbs up in my assessment. Thanks.
Indeed. Dixon Magacha, you've been a friend of the spaces, of the Mongo Capital account. You've been in our conversations over the last couple of years. You've been listening quite patiently for the last hour to the discussions we're having at the moment. And I want to start by asking you the same question I posed to the other panelists. With a lot of fiscal credibility problems from a government perspective, right? We say we're going to bring 5 companies to market within a year. That doesn't happen. Cabinet says, yes, we've approved the sell down of these small stakes we hold in various companies. Doesn't happen. We say we're serious about fiscal consolidation. And then as we're seeing at the moment, our legislators want to expand spending rather than cut it. With all those credibility problems just building up, why should the IMF or the World Bank lend us any money?
Hi, Rama. Hi, panelists and listeners. I think ultimately, at least when it comes to the World Bank and the IMF, ideally, if you were to go down, they will still have to come back and salvage the situation anyway. As long as you try to keep towards the fiscal consolidation path that you agree with them, even if you have slippage, I think they'll always come back and help you along. Because if you got into default, even if they put you through a more stringent, austere program, whatever, you still have to cough up a few $1 billion. So they're invested to ensure that you actually don't go down. And as far as the issues we're facing, and I think I've mentioned it a bit here, we've had issue mobilizing revenues, and this is because of the nature of the economy. We've used taxes to try and boost infrastructure growth. That happened in the mid-teens, especially from the SGR onwards, and that was financed with a lot of debt. And the assumption was then we'll get growth, and that will then boost tax revenues, and then you use that to pay down those debts. That didn't happen. And we got to a situation where a lot of the debt creation that happened in the last few years has actually been towards interest servicing. as opposed to doing any development work. Again, that alludes to the sort of quality of growth we've been seeing. So with this all in light, I think the issue right now towards this fiscal consolidation has not been really an ability to borrow. I think the issue has been the ability to raise revenues. I'm not sure we've spoken for that, because I feel like the next phase of growth will have to come from the private sector. Given the fact that the market is quite awash right now, I think even if we were to try and raise $1 trillion shillings, we could. But all these fiscal sort of printing is not going to go to any productive sector of the economy. It's not just going to go to interest service, which then just is less and lesser assets in the capital and debt markets with low real growth going to the economy. And the structural issue that remains is that the cost of doing business remains quite restrictive in Kenya. The development portion of the budget over the last few years has really shrunk. I think you can manifest next year, the only way we're able to assume such a low the deficit path that we have right now has been by cutting development expenditure further and further. There is estimation of just the next budget having only 7% of development expenditure. And the issue it's so low is because anything above that then would mean that the path we have towards the debt consolidation then becomes overtaken. So the challenge we have is how do we invest this capital to, because that's what will drive down the cost of doing business, whether it's transport, whether it's energy. Someone must invest in that, and then that then drives the cost of doing business, which then forms a base for investors on the private sector side to how we're going to anchor the revenue question. For now, I see the issue of servicing the next budget not as a very large issue. I think we had this call last year around the same time, and guys were worried about default. And my take was just looking at the interest pipeline over the next few years, all the issuance we did at 18%, I'm going to be paying over $1 trillion shillings in interest. And if we just roll over that, even with the small primary surplus, you can easily borrow $1 trillion, even without going to offshore markets. Obviously, that comes with more issues in terms of like maybe a bit of inflationary issues. And again, we're still using fiscal dominance and using the public sector budget to try and see us through. And we know that's been very inefficient. We must figure some way to have the next growth phase move to the private sector.
And with respect to making sure that growth can come in from the private sector, we had this debate between myself and Churchill and Raphael. My view is that, look, government is wasteful. There's a lot of money that we're throwing in the public sector that is not properly accounted for. And yes, there are rigidities in spending, but at the same time, if the private sector engine is not working, we can't squeeze more milk out of an emaciated cow. We need to give that cow time to recover the nutrients, the water that it needs to recover. And my view is that we need tax cuts at some point.
I'm not sure tax cuts will send the right message right now, ideally. I think one of the low-hanging fruit we'll have to address is that we're going to have a lot of cash sitting with both banks and pension and the high net worth individuals. If interest rates come down to the levels we're seeing, if we could find a way to structure public infrastructure projects that could then be financed, whether it's a corporate debt market coming back or pension funds starting to look at long-term infrastructure spending, I think that might be one way that we care about this. Because if yields were to drop substantially and the economy is weak, then this capital that we formed from all the interest have been paid from IFBs and all these other assets, which is ideally for investment. If we could structure projects that were corruption-free and efficient and run by the private sector fully due to government participation, I think that might be one way that we could address the investment that we need to do in the economy without adding debt.
But the counter argument that I guess some of our listeners will say, the argument would be, hang on a minute, all of these ideas about reducing corruption, reducing waste in the Kenyan government, we've heard this, right? We had that in Jubilee 1, we had that in Jubilee 2. There was no meaningful progress in reducing that waste or reducing that corruption. We barely see individuals who are actually being held to account for wasting of our money or cash that's been borrowed in our name, for example. So if we've tried all of these things, right, we've raised marginal rates of tax, for example, on mobile money. We've increased tax bans on personal income. We've reintroduced capital gains tax. We've literally ticked the box of all of these things in the past, and it has not worked. So why not starve the Levi and keep that capital in the hands of private households and businesses where there are far better decision makers there on deciding how they want to allocate that money? If they want to give it to government and buy T-bills, cool. But from a tax perspective, why would they want to give that cash to the state?
I would say on a macro level, spending per capita is actually much lower. If you think about allocation to education, health, and all these other lines, population is larger. Some of these budgets have been frozen for quite a while now. Some are even lower. The difference between now and 5 years ago is that we were spending 300 billion on interest service. Now we're spending a trillion and above a trillion. So 800 billion has come into the system. The offset of that has been cutting on development expenditure and public spending on some of these key issues like health and education. And that has gone to family debt interest. Now, at that point in time, you could say, let's cut taxes. But if you cut taxes further, the market reaction probably might be to assume that the fiscal consolidation path is not going to be achieved easily. And then the market will start asking a premium again on your yields. So you're stuck between a rock and a hard place where you need to evidence that you're actually doing all you can to try and raise the taxes for the comfort of the market and to have a lower yield curve. But at the same time, you do understand that a lot of the money that you spend, a good portion of the budget now is going to some balance sheets, which is high net worth individuals, it's going to banks, pension funds, and those then becomes part of the national savings that are sitting in the system. So if those were to be recycled back and invested, then ideally you'd see a higher tax yield from those investments from the private sector side, and you could then use that to reduce the tax burden. But at this point in time, I think the signal, if you sent that you're not going to be able to raise taxes, you're going to have the same issues you had last year. When the finance bill was cracked, the first thing we saw was some rating agencies downgrading us immediately. That's a lower yield. That got delayed by a few months. Even if we could see on a cash flow basis that down the line, there's going to be a lot more liquidity from the markets to be able to cover the debt service that was coming through. That market confidence, I think, is what these headline tax numbers are trying to portray, that you are not having any tax growth. And the challenge, obviously, or lack of imagination has to be, you have to keep raising taxes to raise that revenue. To me, I'm thinking, because you've already paid this cash out, and over the next 3-4 years, you're going to pay out $1 trillion a year at least. Assuming yields come down, that number could likely come lower, because if you're hitting at 18%, you're now reaching at 7 or 8. Obviously, there's going to be some savings. But what you issue, you're going to pay out. Now, this cash could plan for it and find ways that all these guys could recycle that funds to the economy on the development side. And if they did that, then your tax revenues could go up, and then you could use that to try and reduce the taxes that you raised.
Indeed. And this is a whole debate that we've had in very different circles for a very long time, and we could have it for another 2 hours here. But I do need to bring this to a close. And just to Dixon's specific point around debt service obligations, at least in the medium term, if you're just looking at interest costs alone, right, for both domestic debt and foreign debt, we're going to be spending at least 1.1 trillion shillings on that in 2026, 2027, another 1.1 trillion in the next fiscal year, and another 1 trillion shillings, 1.1 actually, in the fiscal year 28, 29. So there's a debt service problem there we need to crack in one way or another. I need to bring this to a close. I'm going to give my panelists a time to essentially give their closing thoughts on what we should expect over the next 12 months and what we're likely to hear potentially from the Finance Minister, John Badi, as he presents his maiden budget speech tomorrow in Parliament. Churchill, let's start with you.
Yeah, thanks. The beauty about the Kenya's budgeting process is that whatever the CS will tell us tomorrow, a huge chunk of it we have already ventilated about. So we won't get any surprises in a significant way. But that notwithstanding, we still expect the next 12 months, because this budget will be executed for the next 12 months, which will be a year before the next elections. So we're starting to see some of the pet projects being prioritized. I've seen even in terms of affordable housing, some significant units that needs to be turned out in the next 12 months. How credible they will be done, I know opening a can of worms, bringing this issue, but how realistic it will be another issue. But I think that is something that will start coming out in the next 12 months. Obviously, the whole evening is spoken about realism about the budget. If you look at even the budget from terms of the nominal GDP growth that is expected in the current financial year, getting into the next one, it's around 10.6%. And even the ordinary revenue, the growth is around 6.8%. You can argue that there's realism in meeting the ordinary revenue targets. But having said that, we've seen the strains, even in the current financial year, the numbers from July to April, we've missed by 250 billion. So it just tells us that in as much as the government is just trying to be more realistic, there's some strains that we should expect in the next 12 months in terms of revenue mobilization.
And speaking of revenue mobilization, and you're handling the tax function at Deloitte, so you interface between your clients on one end, Carey and the government and Treasury on the other. What are your expectations for the next 12 months?
Thank you. So basically, I might tell Churchill he might be in for a root shock with the tax measures. So let's just cross our fingers. We all know what happened late last year when we had the Tax Law Amendment Act. We did get provisions that were not discussed with the public participation, but somehow the Supreme Court gave a leeway for the National Assembly to go ahead and introduce new provisions. So we just hope there'll be no surprises from a tax angle, but let's see what happens tomorrow. In terms of course, revenue mobilization, of course, you will put it that we are lagging behind in terms of collections. So I would expect a lot of reviews and audit by the Revenue Authority, a lot of scrutiny, and also the issue of VTIMs is really being followed up, and implementation is being followed up keenly by KRA. So again, it's just for the taxpayers to ensure they're complying with the tax laws. They're also complying as regards VTIMs requirements are put in place. So more reviews and more discussions with KRA as we move to the next 12 months.
So in short, Tujipang, we're going to have more problems and more engagement with our tax agency.
Yeah, we have to collect the money for the budget.
That's likely depressing, but it is a realistic take of what you should expect over the next 12 months. Rafael.
Thanks, Ram. I agree with Churchill. If you look at the public finance management framework, it's unlikely that Mbadi will surprise us in many material sense. The reason is that we expect him to make pronouncements of the budget policy statements if you already had since February the 15th. Yes, there will be expectations around revenue raising measures. So there could be little tweaks here and there, especially on the back of the ongoing conversation on the proposals on the finance bill that you pointed to. But materially, and this is the beauty of our public finance management framework now, the budget process started almost October last year. So a lot of the issues are already in the main, and I don't expect any variance, just as Churchill said. In terms of my expectations the next 12 months, I did say, and this is one message that I really wanted to put across, there is going to be a significant prioritization on growth. And in the absence of the fiscal space, there is diminishing below to be able to do that. So what I expect then is, especially given that this is a midterm sort of budget reading by Kenya Kwanza, so with eyes pretty much squarely focused on the next election, a determined administration that wants to come back to power, you're going to see a little bit more, and this is my hope anyway, you're going to see a little bit more execution discipline coming through. Taking the lessons from the July protests of last year, you have seen that already in their tax and spend proposals. I think they're very mindful of the political context. They've changed the game in terms of just the political economy context that we are in. And I think with that room, and especially if you take the earlier point, I was making credit to them that they've delivered on the stability question and taken away the default concerns far much further out. I expect that they're going to show us a little bit more execution, if only with eyes really focused on 2027. And with an administration that's willing to show some good scorecard. Keep in mind, just for a reminder, their objective was to bring down the cost of living, whichever way you measure that. They'll argue that they're doing exactly that. If you look at the inflation numbers, they wanted to eradicate hunger. I'll leave that to the jury, whether they've delivered or not, or they're delivering. Creating jobs, a big question there. Fourth was expanding the tax base. That raised significant noise and is still ongoing. Improving foreign exchange balances, reserves for the record are north of 10 billion. They'd argue that they've delivered massively on that. And then inclusive growth. I'd argue that parties of their broad-based sort of politics is squarely on that. So you'll see a lot more determination on the part of the Ruto administration to execute far much better. And of course, use the bully pulpit to showcase whatever progress in their mind they've delivered. But there's no question that they are in a much more stable macroeconomic environment, which is a good ingredient to our growth process going so far. And so if we can just address the fiscal sort of points that everybody here has spoken to, I think we can be cautiously optimistic, but pay attention to growth. Thanks.
And I'm sure that the individuals who are in the space now will say inflation is down, but I'm looking at 5 years of essentially diminishing real wages and a much smaller amount of job creation in the formal sector, 45,100 jobs last year. So by that metric, for some individuals in this space, they will say, we don't think our employees really have delivered. Dixon, you get the last word to close us out.
Thank you, Ram. I think I agree with the gentleman. I don't think in terms of substance, we'll see much of a difference. You might hear a policy or two that excite people, but in terms of the broad macro frameworks and deficit and spending plans, I think those will remain intact. Over the next 12 months, my take is, number one, I think it's going to be easier to issue this particular year. I expect the sort of trend in interest rates to hold. Obviously, the inflation outlook might determine whether we go further lower, the global macro scenario might become important too, especially if we see the Fed and other central banks keep using how the tariff story evolves from the Chinese side. Maybe it might be deflationary for the world, which could be made for cheap imports. And that by itself would help one of the anchors that Raphael has mentioned, which is the reserves accumulation, which has been going pretty well. In terms of revenues, I think we might still struggle. We might have a 6% sort of year-on-year increase, but we were basing that off numbers which we will not meet. So once you adjust with the actual figures, actual final figures, that number might be closer to mid-teens, maybe close to 15%, which by itself then makes it more difficult to reach that number. Then if the revenue number does not meet up, probably then we could see a bit more borrowing. I know we've been talking about securitization, which in a sense might not look like it's hitting the fiscal numbers this particular year, especially if you're using levies or stuff like that. Ultimately, they do add to the debt burden down the road. And once those come due, if it's a levy that's supposed to be from road maintenance, at the point when it comes due and you have to service the debt instead of building the road, you would have increased that burden. So in a sense, I think the public sector lever is the one that we're still leaning on. And like you mentioned, I think my worry is that the public finance side is always inefficient. And the more we lean on the public sector side, the more we are getting less bang for buck. And ultimately, we'll have to figure out how to support the private sector, because the best way to grow would have to be a job creation, tax revenues going up from the private sector, then that leads to less borrowing and sustainable macro situation. Because if we keep going down this path where we have a revenue slippage, then we have more fiscal borrowing, ultimately the debt consolidation will never happen. And we remain in this sort of tighter stance for much longer. So now with inflation lower and macros quite stable, weather are behaving well, we have a small window. But you can imagine if you have the same scenario where things are different in the world, maybe energy prices have gone up, if it's like a drought situation, and you're in the same scenario we have now, then things could unravel quite fast. So we are running very close to the edge. We need to figure a way how to get back. And to me, it has to be less leaning on the public side than figure a way to the private side. That said, I think over the next 12 years, over the next 12 months, I think at least on the fiscal borrowing side, that the government will be able to borrow. How well they execute, again, is debatable. I think the public sector is inefficient, and I'm not sure in the long run we're going to get out of.
Thank you. Thank you very much. My thanks to pretty much everyone who's been on the panel today. With us, Dixon Magecha, Chachido Gutu, and Magondu, and of course, Raphael Agogon as well. As always, thank you very much for your time and your attention. We do not take it for granted. It's extraordinarily important to go back to something that all of our speakers have mentioned. We have a bit of time in hand now. We've kicked down maturities into the 2030s for a lot of our foreign debt. Things are stabilizing, but what will we do with the time that we have available? That's the billion-dollar question that we need to answer. That's it from me and the Mwango team. Thank you very much. Have a good night.